Hi you guys, welcome back to the program. Today we're going to talk about the 4% rule. We said the other day that we were going to start a retirement series, and this is going to be the second part. Now I know I mentioned the 4% rule in the video last week, but today I want to go in depth about it. We're going to talk about it next on the Firefighter's Financial Toolbox. Hey, welcome back to the program, you guys. If you're new to the community here, welcome. We talk about investing, we talk about retirement, we talk about tax savings, we talk about all that stuff. If you're new to the community, subscribe to the channel. Give me a like if you enjoy this and keep coming back. We try to make a couple videos a week. Well, let's get into it. Now, this is video number 2 in my retirement series. Now, last week when we talked about what our number was, what our retirement number was, we talked a little about the 4% rule. Today we're going to explain what that 4% rule really is. It's a safe withdrawal strategy, but let's talk about how it became the rule for a safe withdrawal. First of all, the 4% rule is based on what was called the Trinity study. 3 professors at Trinity University did a study in 1998 where they looked at 100 years of stock market returns, and they figured out a number that would make it safe for somebody using a 50% stocks, 50% bonds asset allocation. And they determined that in 100% of the cases at 30 years, withdrawing 4% became a safe withdrawal rate. They had a little bit of back study. William Benjamin in 1994 did a similar study, and the Trinity study sort of confirmed his results. They looked at a time period between 1915 and 1994. So about 80 years of stock market data. And then they actually re-looked at the study after the 2008 recession, you guys, and they updated it. Now, if we look at some of the updated numbers, we see that if you had a 50-50 portfolio, it would have been good to go at 30 years, 95% of the time. So there is a little if in there. However, if we had a 75-25, so 75% stocks, 25% bonds, it was 100% of the time at 30 years. So how does it work? It's easy. You take the number, your number, when we talked about last year, you figure out what your annual expenses are. And whatever your annual expenses are that you think you're going to need in retirement, multiply that number by 25. So for example, let's say for easy math that your number was 1 million. Divide that by 25, we could safely withdraw $40,000 each year. Now, remember, this does account for inflation. So the first year we would withdraw $40,000. The next year we would withdraw the added amount for the inflation from that year. So let's say it was 2%, we would withdraw $40,800, and so on. Now the idea is you're keeping the money invested, so as long as it's growing, it should continue to be enough for you to live on. So how did they come up with the number 4%? How did they come up with that number? Well, just pull it out of the sky. What do they do? Well, if we look at 100 years of stock market data, we find that the average stock market returns annualized over those 100 years is 7%. Conversely, the inflation rate over the last 100 years has averaged 3%. So if we take our 7% from the stock market gains, subtract 3% for the inflation that we've lost, we come out with 4%. That's the easy math. There are some people that say 4% is too aggressive. And remember, these are based on historical returns. Historically, bonds have returned between 4 to 6%. Now, if you look at the bond market now, it's less than 2% for a 10-year treasury. So a lot of people think the 4% rule isn't going to make it. If you feel that way, then use the 3% rule. The 3% rule means that instead of multiplying your annual expenses by 25, you would multiply them by 33.3. That way you would take only 3% of your portfolio each year and adjust it for inflation. And we find that that works astoundingly better. Now, The other thing we need to talk about is sequence risk. What if I retired in 2007 and I had $1 million portfolio and I took my first 40,000 off, right? And then the stock market dropped 40%. Beginning in 2008, my portfolio would already be down to $600,000, you guys. Actually less than that because of the 40,000 I took. Now, in a situation like that, remember, stock market losses earlier in your retirement are much more devastating to your final number and how long it's going to last. That might be a time, if the stock market's down, that we decide we're going to work a year or two more until maybe this turns around. Or what if I can't save $1 million? What if I can only save, let's say I'm a good saver, but I started late, and I only end up retiring with $250,000. Now, let's say that I have $250,000 and I'm invested 75% in stocks and 25% in bonds. At 30 years, if I'm withdrawing 4%, I have a 98% chance of success, you guys. Now, the important thing to remember is if I'm taking 4% of 250,000, that's only $10,000 a year from my portfolio. So it's going to be lean. So obviously the bigger you can get that portfolio, the better. The other thing you can think about is if the 4% rule becomes a problem on a year when the stock market is really down. Maybe you take a little bit less this year, but as a rule, 4%. Based on the Trinity study, based on the fact that when they did their study in 1998 and updated it for 2008, in fact, in 2008, when they did the updated study, they found that with the 50-50 portfolio, you still had a 95% chance of success at 30 years. And if you did a 75-25 portfolio, then you had a 98% chance. So, I'm not saying take more risk than you need to. I'm not telling you this is going to work for everybody, but it gives you a good idea to base the number that you need that has worked for a majority of the time. Remember, the stock market always has risk, and it could dump tomorrow, and it could stay down for years. It's happened. What if we had another recession? What if we had another depression? It can happen, you guys. So, think of my mantra, save as much as you can. Invest early and often. Think long term. Keep your fees low. All right, I hope you got something out of this. If you did, give me a thumbs up. Subscribe to the channel, and we'll see you again next week. Thanks a lot.